Welcome to the Angel's Brief, the podcast series. We bring together the smartest minds in angel investing and ambitious startup founders to share their stories, insights, experience, and much more. The host for today's episode is Duran York, the CEO of Cityside Ventures and the co-founder of Birmingham Angels. So let's get to it.
Okay, so today's guest is Dan Bober. Dan is an experienced angel investor, is a board member, startup advisors, and one of the founding members in Birmingham Angels. Also, a University of Michigan alumni.
Correct.
Right? Spent about 18 plus years in the banking industry and the financial services in Wells Fargo. Was the chairman and founder of Incognita Technology, serving in a variety of boards, such as Birmingham Financial Services, Commercial Real Estate Financial Council, and many, many other startup that I know of, startup here in Michigan. So been around the block, as they say.
Correct.
Okay, welcome. Thank you for taking the time.
Thanks for having me.
So, first question I ask every investor on the panel here: why did you decide to be an angel investor? I mean, you could do many things as a stock market to private market to equity, real estate. Why angel investing?
Well, certainly diversification is a big part of it. I'm sure that's true of everyone, or should be true of everyone looking at angel investing. For me, it was really more a matter of next phase of my career. The most fun parts were always building a company, growing a company, and it wasn't even the business per se. It was, the opportunity to work with, identify, help grow, couple of handfuls full of people that are, sort of Six Sigma exceptional folks, wanted to do more of that. And, I think angel investing is unique in that if you're of the mindset and have the desire, it's probably unlike any other investment class where you really can be hands-on and work with, talk to, do due diligence one-on-one with an entrepreneur. And in many cases, you have experience or contacts or something other than money. Certainly, they want the money that can help them. So you can actively help your own investment, and that's not true picking stocks or bonds.
But I must say that it's very kind of interesting to hear it from a banker, because bankers usually kind of be shy from startup companies that have a high risk and maybe losing the money. So it's like funny it's coming from a banker, but it's interesting. Your point is well taken.
Yeah, I mean, absolutely.
So if you're looking at your journey as an angel investor, how many years you're doing it?
It's probably 6, 7 years now.
6, 7 years. So if you're looking at your journey as an angel investor, what's some of the critical learning points that you collected over the last 6 years that you say, well, I know it now, but I wish I knew it 6 years ago?
Well, I was surprised, frankly, pleasantly surprised about the robust ecosphere and just the volume of really great technologies and concepts coming out of Michigan. And certainly, the universities in the state generally have really terrific offices for exporting their intellectual property. I think the average Michigander, understands that we do cars really well and, designing and building and engineering them. I don't think they have visibility in it. And it's really unfortunate that the state, there isn't more energy and frankly, PR pushed down to the residents in the state that really help them understand the really cool stuff that's being, designed here, conceived here, coded here, and manufactured here. Literally, you take a company like Atlas in Traverse City, where literally there's rocket stuff being done in the state, or I don't know, Histosonics out of Ann Arbor, where literally they're using ultrasound to blow up tumors. Stuff that as a Michigander, you would be really proud of. So certainly that was, learning lesson number one. Lesson number two, I think really angel investing is really well suited for somebody that's intellectually curious, wants to, ask questions and dig into things. And certainly, to the extent that a prospective investor is sort of wired that way. Again, as I said earlier, angel investing is a unique asset class that allows you to do that. And being able to do that, sit down with an entrepreneur and ask questions and just sort of follow where the conversation goes is, certainly great discipline and certainly something that I think is a key to success. I think another surprise in this, having been an entrepreneur, having had my own company, having had a tech startup, I'm and being on the other side as a lender, I'm used to entrepreneurs wanting to get the money quickly. Nam de geld, or get
Right.
the money basically, and I'm continually surprised, frankly, even after 6 years, about how long the process takes from when you first see a pitch to getting that money, writing that check and getting the money into the investor. I mean, part of it, is frankly understandable, just given the bodies and questions involved, and at some point, usually attorneys. But the other part, just procedurally, it's a clunky process, and frankly, that it continually surprises me. I'm used to, like, these are desperate people living hand to mouth. They're raising money because they need it, and need it to make
Right.
payroll.
Like being a banker,
and
it's
it takes
Right.
literally a couple of months is the quickest funding I've seen, and I've got like 40 odd in angel investments now, or companies, and every one of them took multiple months for me to say, like, that looks really interesting. Ask my stupid Dan questions, and then get the money into them, and hopefully helping them grow or stay alive, as the case may be. And
Right. Well, you also have a concern as an investor that even you decide to invest and you commit to a company, you want to make sure that the other investors coming along with you, so you're not the only one give the money to get burned pretty quickly and then they're running out of it. It's like, that's why syndication is key, right?
yeah, well, absolutely. And I think groups like Birmingham Angels and other angel groups, having other smart people take a look at it and be able to compare notes, ask questions that you didn't think of, or at least provide a counterpoint. Call you on your enthusiasm is a valuable thing, and certainly, ultimately, unless you're incredibly wealthy, you need other investors participating to both diversify your own portfolio and get sufficient funds to get the startup to
Funny
its next
thing,
point.
true or false, funny thing that I learned in the last couple of weeks, or at least discover, if you will, is that people that in the beginning of their life accumulating wealth, like younger people, like young professionals in the 20s and maybe early 30s, it seems to me much more risk takers than the wealthy individuals who already made their money. And I was asking myself, this is weird. I had attended an event last week with a lot of wealthy people, and I asked one of them, why is that? Because the logic said that if you have a lot of money, you don't mind to risk it. But you find out it's actually the opposite, because they said, because we experience on our blood and our flesh and blood what it takes to make this money. So we're not so easily letting it go.
Well, that's true. I think probably earlier in your investment thesis or experience, you're trying to build that foundational sort of stuff. So I think it's sensible to first focus on that, and certainly, absolutely, the younger you are, the more you should be thinking about investing in an angel fund. If you really want to diversify, you should have a sliver of something that's well diversified, and you're building your own career. You probably don't have time to be sitting listening to pitches and things like that, unless you're choosing that as a
Right.
career sort of option. But at some point, it's sort of like life insurance. Probably the best time to start a life insurance policy is when you're young, and it's very
Right.
inexpensive, and it can build. It's the same compounding thing. Same time to buy some bonds or get a bank account going, and earlier is probably the best time.
That's, by the way, the
Conceptually.
Rockefeller family.
Yeah.
That's how they build their fortune, right? Buying life insurance for all the baby born in the family, and the life
Yeah.
is on basically.
It would be hard to be an individual angel younger early on because you couldn't write a check enough
Right.
checks to be diversified, and that's where a fund makes the most sense.
Right.
Certainly, as your portfolio grows and net worth grows and your ability to write checks grows, if you've got the time and energy to do due diligence, look at companies thoughtfully rather than just pushing money out of
Right.
the table and saying, "Hey, I hope it works out." You're in a position where you could be more active investing in individual transactions. But I think it's important for prospective angel investors really to consider their own not only net worth and ability to write checks, but also their time to think about and do due diligence. If they're growing their career, spending time with family, traveling, whatever it is, they're better off, frankly, from my perspective, investing in a fund, like Great Lakes or any one of other funds out there, and delegate that due diligence work and diversification to somebody else. And there's always an opportunity if they have, once a quarter, I'm going to go in and see some pitches just to see if they
Yeah,
like
but then
companies.
you're not a typical investor, because most of the investor that I know, and a lot of our members in Birmingham Angel, and some of them, are not active investors. They want to come once a month, look at some company, have a glass of wine, and then eventually, I got calls from some of those investors. Where should I put my money? And I'm saying I'm being very careful to give you an advice, but most people become lazy when you're comfortable. It's like they don't want to do the hard work. They don't want to do the due diligence. They don't want to spend too much time on it.
I I've met an awful lot over the past 6 years, and that's true of some of them. I think particularly for first-time members or prospective joiners, I see a lot that have an appetite, think they have an appetite for it. Then they find out, I've got to see probably 3 pitches a month if I'm really going to do this. I'm really going to diversify. And I probably want to ask some questions and think about it a little
Right.
bit or research a little
Right.
bit. Their appetite or enthusiasm wanes, and it's a smaller portion that actually show up, do the work,
Right.
write checks periodically, and again, the good nice thing about the market is that there is a spectrum where you can go from fund and it's just another fund that I have in a portfolio of diversification, and you can actually hop in and hop out, attend sessions, and if you want to increase your exposure because you saw a company you think that's really going to be great, the negative about a fund is that if they're going to have 20 or 10 or 15 investments in their entire portfolio, you as an individual investor have only a fractional portion
Yeah,
of
you can
that.
only do Sarkar.
Right. And if there's a really spectacular thing, or if you say, if I had known we were investing in that, I would have doubled my
Right.
investment. And there was an avenue, sidecar it's called, where you can follow the fund's investment and increase your exposure, or you can write individual checks on individual transactions. So I think there's an opportunity for everyone to play depending on their
Right, but not everybody taking it like you took it from kind of retirement. It's actually, we have a joke, my cigar club, we meeting, and most of the age group is 65 plus, and we all kind of have a joke. It says, retirement is for losers. and the reason being we saying it is because life expectancy is 90, 100, and what is retirement? Is stop living. So you took it to a point that it become your career, so to speak. Angel investing,
Yeah.
30, 40 investments. I don't know many independent investors that even get to that level in 6 years of 30 or 40 investments. But most people don't take it to that degree. They want to be involved to a certain point. And then, I don't want to spend all my time doing it. That's not what I'm looking for. So if you're looking at your career, if you want to share with people some of your core methodologies or your best practices as an angel investor that kind of like people should follow as a discipline?
I think at its core, even though you're everyone hears venture capital, they assume immediately technology or the drug that's going to be the next cure for cancer or something like that. And while that's true to a point, my personal thesis has been, at the end of the day, I'm investing in, first and foremost, a guy or gal or a team of guys and gals that have a great concept, and they could have the world's best concept. If they can't articulate their investment, if they can't pitch it to investors, if they can't reduce something that might be really complicated to sort of balloon animals and hand puppets is sort of my vernacular, then they're probably not really going to be successful, because they won't have the ability to raise the money to run a company, because they might be great about designing something, but they won't be able to execute. Similarly, I try as much as possible during the due diligence to see whether the entrepreneur is organized. If they can't put together a deck, if they can't put together a war room or due diligence or respond to investors' query, that's probably not a good sign. And unfortunately, you don't always figure that out over the course of the pitch and any questions and answers afterwards. But ideally, you try to identify that as early as possible, because if they're not organized enough to know that investors are going to ask questions, and the more serious the investor, the more successful they are, the less they're dealing with angel investors and more they're dealing with professional venture capitalists, they're going to, those later rounds are going to have people that are incredibly knowledgeable about the area or technology, and they're going to be really, really smart about tearing into every nook and cranny of the company to make sure it's well set up, it's well, the accounting is in order, the legal's in order, HR and everything.
But I know, in context, at least from my perspective, true angel investing, it's all about human calculation, not financial calculation, right?
Oh, yeah.
You're betting on the driver. So in Michigan, we say the driver, the car, and the race, right?
Yeah.
You're betting on the driver. Later stage VC betting on the car more than they're betting on the driver.
Yeah, that's true. But if I was saying, early on, I'm looking at the person. First of all, it's great to have great technology or concept or code or something or other. I'm sort of putting that secondary. I'm looking at, in your vernacular, the driver. I'm looking at the entrepreneur or the team, the two
Can they drive?
founders.
I mean, I can fix the car.
And I'm extending that and saying I'm trying to also ascertain early on whether they're organized. If yes, they can have a great concept. Yes, they can pitch and communicate effectively and powerfully and succinctly. Then are they organized? Can they respond quickly to logical questions? If there was something that was asked of them in an angel, Q&A session, do they get back or do they fumble? Have they thought about their own technology and profit and loss? Do they at least have some idea early on how they might raise revenue? And, is there just one lever that they have to raise revenue, or do they have multiple levers? On the expense side, do they understand where and how they might market their technology, or, all of the different dials that they have in terms of expenses? And I think any angel coming in understands that the company may not have yet had the time or may not be far enough along to have experimented with every possible way that they have of raising revenue or controlling their expenses. But at least, when you're asking them, have they thought about that? And if you're investing a little later and they've started to raise some revenue and started to have some real expenses, have they already started to fiddle with those things? And things like that. It's like, but it's the person. Are they, can they communicate well? Are they organized? And do they understand their own in your do they understand their race car? Do they, or not? And if you're
We say,
talking to somebody,
we call it an operating habit. So you're looking at listening and acting, of a person, the way they think and the way they act and the way they present themselves, right? So it's like you putting the driver and kind of ask yourself, it seems like at least they have the discipline coming with that. But I'm more interested in breaking it down to more practical things for people that listening or potential investor listening. So for me, for example, I'm looking at opportunity. I created this guideline that says, okay, if the company raised more than X amount of dollars, or in the particular industry, or the valuation is in particular level, what some of the practices you're using to filter opportunity coming your way to say, I'm going to look at this, but I'm going to take a pass on this. Beyond the person, the
right?
entrepreneur.
Okay, well, beyond the person, certainly I'm looking at however the transaction's structured, and certainly there's a lot of different
Right.
Ways of organizing things. As a personal matter, I'm not really keen on safes. It's a safe as a promise to convert whatever check you give them at some point in the future, as yet undetermined,
Right.
into equity in the company. There are no milestones or guideposts,
Right.
or it's just, here's a check, hope something happens.
Right.
And that something was designed in Silicon Valley, and where things happen quickly. Maybe it sort of works. I can sort of wrap my head around it. In the Midwest, it's show me state sort of mentality.
Right. So what you're saying, the first thing you're looking at is the structural transaction. So if it's safe, you say, okay, this is in the bottom of the pile, the
Correct.
convertible note or equity around it.
And then valuation, is, if they've not really built anything yet, valuing their company at $27 million is probably unrealistic.
Right.
There's as much art, and probably more art than science, in what the initial valuation is, but does it make some sort of sense? And after you've seen a bunch of transactions, you get some general idea what a startups are generally valued at.
Right.
And is that logical? Are the terms of the deal, like in this interest rate environment, somebody that's proposing a convertible note with a 2% interest, not that anyone invests in venture capital for a coupon, it cares about it, but having something that's logical. And if it's a convertible note, 2-year term is probably pretty standard. If somebody's coming in with a structure as a 5-year convertible note, that's excessively long.
Is liquidation preferences an issue for you?
If it's a preferred sort of deal, if there is, again, that's sort of structural thing. If it's a preferred equity, certainly liquidation preference becomes relevant, or at least is interesting. Again, if you're investing early enough, if your first check in, those terms may
not exist. But on a convertible note, it makes a difference to have liquidation. We used to talk about 2x liquidation preference, and now we kind of emphasize it in 3x in many ways, because according to Carta, 65% of all the acquisitions and mergers happen between seed to Series A. So we kind of saying, okay, if they're not going to go for Series A, B, C, and D, then liquidation preferences can be value for us as early investor. If you get your money back 3 times within 2 years, you're not going to cry wolf, right?
Yeah, not the worst thing, but all of those things are very context. Are they walking in with a safe or a convertible, or is it true equity round? If it's equity, how do they arrive at a value? It's, again, they've never had any stock. They're just selling their first stock.
Right.
How do they decide it's worth 20 cents versus $1.97 and all those things? But you have to.
So you're looking at the structure, look in the industry, look at the amount of money they raise, what structure of the deal, what's the benefit, and after you say, okay, this is a company I want to look at, what's the other practices you're using from that point on?
Well, so you've looked at the driver, you've looked at their car or their technology. You understand what sort of engine it's got in it based upon the structure of their transaction. Then I'm looking at, do they have any intellectual property? And if so,
Wow.
how strong or is it? And if they don't have any intellectual property, are they on a path to get some? And if they don't have anything that's defensible that way, is there something else that's truly proprietary? And if they don't have any of those things, if it's something where they are just the first to have this concept, two questions then, I guess. A, are they equipped to get so far ahead of everyone else so quickly that first mover advantage, that couple of laps before anyone else figures out how to do this, because they can't defend it. It's not it's not unique. It's not defensible from an intellectual property standpoint. These guys just thought of it first. Then are they far enough ahead that they can do that? And their ability to convince a prospective investor that not only are they the first people to think of this, but they can get so far ahead that they will, and the investors will profit mightily because they got
Would you
so far
prefer
ahead.
deals to follow other investors, or you prefer deals that you are one of the original investors? Would you take the lead on some investor? Where are you at in that?
I've taken leads. That's all context dependent. All things being equal, I would rather be an earlier investor rather than one that's later, because that's, most risky. It's the most profitable potentially, and that's
And you get
generally
to
why it
dictate
becomes
some of the term, right?
venture capitalist. And you might have the ability to
Okay.
get some terms or additional consideration, warrants or options by being truly first check in. It is comforting and de-risks things if you can see other investors in. Absolutely, that's attractive. Particularly if you know and trust the judgments of the other investors. But I've also invested in a round where it's de-risked, but there's still enough potential
upside, yeah.
profit. Yeah.
So you more likely your deal flow is more likely coming from sources not company knocking on the door on the street say, hey, I have a deal for you. So you within the community or the ecosystem, you follow the deal flow, and you're talking to companies that come from places you respect, incubator accelerators.
Yeah, I mean, primarily angel groups are certainly have the bulk of the flow because they have teams or people or websites, whatnot to get prospective transactions into the top of the funnel. I have my own contacts. I do some of that traffic,
Right.
but I'm not out, pitching that. Just at some point, if you're out there enough, people will start to, there's a gravitational attraction.
Right.
Things find their way, which is not necessarily attractive because the nature of the beast is you got to say no a lot and
Right.
bad
Right.
karma.
So, a couple highlight things that you recommended if anybody listened to it say, oh, I want to become an angel investor. What are the things they need to consider in making the decision to get into it?
Well, I think, again, they need to look at their own appetite for participating, asking questions, and just doing their own due diligence.
Level of involvement,
Yeah.
if you will.
And then certainly the group, if they're going to join a group, just to improve their deal flow and have other individuals that they can leverage in terms of experience or just sounding board. Like, this looks good to me. What about to you? Sort of
Right.
sort of thing. Certainly consider whether they should be in a fund or fund and picking and choosing additional ways to get exposure to transactions or just one-off individual angel investments. That's a decision to be made.
I'm going to ask you a question. It may be an odd question. You can free answer or not. But if I considering getting into angel investing, and I'm saying, okay, I'm going to build a portfolio of about 30 companies over the next 5 years or so. how much money do you think I should allocate to that endeavor, to be effective in it? Not necessarily saying that's what you did, but, I heard from different people, like 500,000, a million, two.
Well, what's interesting about that is when you go to pitches, you hear large numbers. We want minimum investments of $25,000 or something, which is a lot to put into any individual company. And there aren't a lot of people that can do that enough to build a diversified portfolio. What's interesting is I think investors hear that and are put off. What in every situation I'm aware of usually happens is the group will have access or the ability to generate a standalone vehicle, an LLC,
Right.
and
SPV, special purpose
and
vehicle.
to the extent that they have enough active members, they have the ability to have members in that LLC probably starting at about $5,000. I think even though, and what's interesting to me is while any fund I'm aware or any group that I'm aware of acknowledges that, yeah, we take as little as $5,000, they don't tout that enough or at all. And by the same by token, they rue the fact that there aren't 30 odd people sitting in their meetings willing to write a $10,000 or $25,000 or $50,000 check. It's like, well, some people may be in a position like the company that they may write that, but frankly, 20 people writing $10,000 or $5,000 checks is $100,000, and I've not seen any angel or any startup that wouldn't take $100,000 check.
It's
and
true.
They don't really care whether it came from 20 people bundled together as an LLC.
Completely, I agree with you completely. But there's a cost to the SPV too. So you need to reach certain threshold to say it makes sense.
Oh
to
yeah,
do
yeah.
an SPV.
And you probably the magic number is about $100,000.
Okay.
And what I'm saying is it's $100,000, and that's probably in order to do the accounting on that entity invested in this startup. Probably $100,000 makes the cost of having that vehicle rational. But nobody really seems to focus on the fact that 20 people writing $5,000 checks is as good as two guys writing $50,000 checks.
I agree with you completely.
Yeah.
But experience looking backwards 5 years that we're doing it to Remembering Angels, are the average checks that the investor writing in our group, it's not 5,000, it's much higher than that.
Yeah.
But I looked at the top 5 investors that invest money, and when we kind of look around, I'm just saying it not as a it's kind of like it's not require, but you want to consider that in order to build a portfolio of 30 companies or even 40 companies over 5 years, it will require capital somewhere between $750 to $1 million.
Yeah, I mean, certainly that would be
Over time, kind of
terrific.
thing, right.
But you were talking about for angel investors starting up, and I guess my perspective is you got to start someplace, and certainly you need some diversification. And I guess my advice to prospective investors is, you could start small. If you want to set aside $50,000 over, say, like a 2-year period and write, $10,000, $5,000 checks, you're going to get diversification. And you just need to be in a group where your $5,000 will be bundled with reliably another $95,000 or more.
Agree.
In LLCs, and
but I see a lot
yeah.
of investors that do like when I had conversation with them, I did 2 or 3 investments and nothing came out of it. I'm selling. It's like,
yeah.
Well, you need to get to the 10, 15 plus before you call the shot. Otherwise, you're wasting. So my point is to people that are watching, if you have $15,000 or $20,000 sitting aside and you want to become an angel investor, it's not the same as to say, I will have to spend $1 million over the next 10 years. I'm going to start with 50,000 and I'm going to make sure that my next bonus and stuff, because I'm going to allocate more money to build my portfolio. Otherwise, you're not diversifying, you're risking yourself.
Well, if you've got that $25,000 that you've allocated as part of your broad portfolio, so it's a teeny sliver, it's a 1% or 2%, whatever the number math is. That's probably not money that you should be doing on investing in an individual angel transaction. You get a quarter unit or whatever the minimum price of poker is, or a quarter share of Great Lakes Fund, or pick another fund of any sort. That will get you diversification.
So what we actually saying to somebody consider angel investing, first you need to ask yourself how much money or percentages of your overall capital you can allocate to angel investing and over what period of time. Are you active investor, passive investor? Are you high risk tolerance, low risk tolerance? You need to kind of know your own DNA as an investor to get into it, and know that it will take money that you have to park for 5 to 7 years without seeing any return. It's not liquid as anything else that you have in your portfolio. You click the button and liquidate, you can't. There's opportunities, but not as quickly. So that's what we want to kind of people to consider. And you're right, consider Angel Group, and there's many Angel Group in the state of Michigan. Birmingham Angel is only one of them. So there's Angel Group, Angel Fund, and other maybe less formal group of investors, that clubs together. So the next question, I want to kind of take a sharp turn to something else. How do you see AI impact the future of tech? And I'm not saying in a ambiguous kind of way, but the CEO of Microsoft came with a statement a couple of weeks ago saying that SaaS model is dead because of AI. So as an investor looking at a lot of things, I'm just want to hear a perspective. How do you think AI is going to change the future of tech? And what we took as the holy grail of angel investing is SaaS models, which has come to question right now.
Well, if I knew the answer to that, I would already have my island already. It's interesting because certainly I'll tell you the biggest effect I've seen over the past probably 18 months as AI has grown in its relevance is that I think every other pitch now finds a way to append AI to their deck and pitch. And probably 90% of it literally just found a way or slide that they could tack AI or type AI onto. There is absolutely going to be a lot of money lost on AI here near term because it's changing so rapidly, and it's so easy for prospective investors or entrepreneurs to tack AI on there, get a little enthusiasm from prospective investors, and really not have done anything truly using artificial intelligence. Similarly, there are absolutely enormous fortunes that are going to be made by entrepreneurs that truly have leveraged AI, and I think also either have their own or have access to or purchased the rights to relevant data that can be used to train the AI and then allows them to do something. So they've got AI either off the shelf or that they built themselves. They've got a proprietary data set that they somehow have access to. And then now they've got essentially a smart warrior that's trained and can be used to do something. And, the list of the somethings that could be done given that.
Somebody mentioned it to me the other week that AI is like, what they say that you can be the jack of all trade and master of none. So a lot of the AI that we see is kind of the jack of all trade. People give it it can do anything. But what is the something that this can do that it's unique? We are familiar with one of the company in our portfolio, Junction AI, that pivoted. I don't remember if you invested in them or not.
No.
But we got the recent report from them about the revenue they're stacking this year, next year, because they become a vertical AI. They find a solution. applying AI to a particular industry with a particular pain point, and there's like boom, it's going like this. So like the agent AI, so to
Mhm.
speak, the expert warrior, as
Yep,
you see.
yep.
So, but you know, remember the internet, the early days of the internet, before they invented the TCP/IP protocol, the IP address, the internet become like ambiguous, and suddenly when they created this IP address, boom, the internet just exploded. We suspect, and maybe we're wrong, that this protocol were not invented yet for AI, and somebody will come up with that at some point, and then boom, everything gonna fall in place, right? So it's kind of the Wild West right now.
Yeah, I think it's a good corollary. There will be probably, again, if you're going to use the internet analogy, there will probably be multiple uh, gatekeeper role or applications that um, are leveraged.
And we're not talking about the regulators at all in this
Right.
branch,
Well, the regulator, that the one thing I can say with certainty is that the regulators are probably 10 years behind where they need to be
right?
given
But
what's
that's what I'm saying.
happening.
But that's also a
Yeah.
problem because they're 10 years behind, and the AI is moving in the speed of light, and suddenly they're going to catch up and say no. And this, okay,
Yeah.
I get it.
Yeah.
So, from your perspective, we have a new administration. I don't want to get to politics, but from economics perspective, so there's a new administration. What do you see from your banking experience and understanding economics the next 4 years supposed to look like with the new administration?
I wish I knew, and just met with my financial advisor last week, and they don't really have an inkling. And certainly, there's an awful lot that has been proposed that looks at its core to be really inflationary. And I'm hoping at the end of the day that there is enough deregulatory pressures or plans built in that it sort of offsets and you might get something marginally positive out of that. I really just don't know, but
Everybody say that he is pro-business. We can't take it away from him. He's a businessman first
Yep.
and foremost, right? So he cannot be not pro-business. The question is this become a Wild West with no rules and everybody carry a set of guns and shoot all this stuff, especially all the stars that he have around him with Elon Musk and everybody else? But it should be a pro-business administration in many ways.
I'm hoping for that, just selfishly for my own portfolio, and to the extent that the past couple of years really not having anything to do with the political environment, more just the economy coming out of COVID and all that happened after that, really I think put the angel market and exits, and certainly the M&A and PE market, all off cycle probably by about the 2-year COVID period. It just sort of was a break in the timeline. And I think if nothing else, and you already started to see this middle of last year. So again, it's not, I don't think, tied necessarily to the political environment. There, for a lot of reasons, was a positive shifts that started sort of subtly middle of last year. I mean, the economy's been growing great. That's part of
Right,
it.
there's
And
economists from Columbia that supposed to, I heard yesterday, come with a new book called Economy 2.0,
Mhm.
which is basically questioning the 7-year cycle that we're living in for the last, like hamsters, he said maybe
Right.
the Economy 2.0 is nothing to do with those cycles anymore, and we need to look in different fundamentals to identify what's happening.
Yeah, could very well be. And certainly, we both are old enough that we've lived through multiple cycles. This period for probably the past 10 years or so, certainly 7, has been odd. And again, there is the COVID shift built in there and all of the um, support that the economy and the world required. So
Oh,
yeah.
I appreciate it. I mean, we can talk hours about it, but so for closing, last call, I mean, in terms of, again, everybody's watching that, considering angel investing in one form or another. Anything else you want to comment, suggest?
Well, certainly, I think there's enough material in here, but I think the one thing that we really haven't talked about is just how interesting, compelling, and fun it is to see um, pitches, the technology, the stuff that's people come up with is incredibly fascinating. I mean, literally, certainly join an investment group, invest in a fund, bring a bowl of popcorn because there is some truly, truly
I'm
interesting
with
stuff.
you. I'm with you. I'm with you. I'm with you. I tell my wife sometimes. I mean, because running the Cityside Venture and Birmingham Angels, uh, I probably watch on an every average week about 35 to 40 pitches. And sometimes I come and I say to my wife, she looked at me and says, "What?" I said, I see things before the world even know it's coming in the infancy of things. And I'm amazed and sometimes I don't have any words to describe how people come up with all this stuff.
Well, not only that, it's by definition, positive energy, uplifting, life reaffirming sort
Right.
of stuff. You've got, and I think everyone always perceives that these are young kids. There are out of thousands of pitches now. Yes, absolutely, there are some young kids, but there's a lot of sort of middle aged, change of career, or I've been had this idea burning a hole in my brain for a long time.
Right.
These are people that are building stuff, creating stuff, and are trying to birth that baby, so to speak. So it is by nature something that is positive and potentially incredibly financially rewarding.
Absolutely. I mean, I can't imagine doing anything else. And as we internally talk about it, angels, angel capital create businesses and create jobs. The venture capitalists coming in and reorganize the capital in some sense, and the private equity groups are rearranging the assets. So in any way to say it different way, angel create the jobs, private equity get rid of the jobs, so to speak. It's like recycling the
Yeah,
business.
yeah.
But many of the angel investors are operators. It came from family businesses operating. They understand the moving part of operating a business. They not. You said something earlier that I don't 100% agree, but not necessarily disagree. Many of the venture capitalists are financial thinkers. They're not business operators. It's a different approach to looking at the business at some point. But angels understand how it works, and it's interesting. So, with that being said, I want to thank you for being one of our first guests on the show. It's really important to us to take the message out there to tell people you're sitting in the sideline. There is a way to participate with reducing your risk and contribute to the community. And I wish us both that 2025, we're going to see some of the popcorn pop up.
Uh, Amen. I think so, based on what I'm seeing.
Yeah,
So,
I know. But thank you, Dan.
yep, absolutely.
Are you interested in becoming a member and joining our group? Please contact Jerron York by phone 248 981 6688 or visit our members' website by using the following QR code. We are looking forward to talking to you soon.